contrary to popular belief, not everything an HOA does is exempt, and so you often find that the treatment or the tax treatment of the levies and those sort of things by HOAs are not always done properly because there's this misunderstanding that it's just everything is exempt, when that is not the case. And often you'll find, especially with body corporates and homeowners associations, there are plenty of stakeholders. I mean, if you think about some of these large estates, I always explain it when I speak to the trustees of the body corporate or the HOA. I said that everyone in there, you know, in the 100 units or 1,000 units or however many units there are in this estate or body corporate, all of them have an opinion and all of them think they're smarter than the next one, and all of them will know some tax person who thinks they know everything. Right, so the reality is this is quite a complex field, and this is something that I have in my office applied to SARS for rulings before, because it is complicated. All right, so without further ado, let's get into the session. Right, so you all know by now who I am. I'm Unicus. I'm the Managing Director of Unicus Tax. For those of you who are joining online and not from my office, please note that this training is designed for my office, right, for my staff. For those of you who are joining online, really it's just for your interest's sake. I have had the question before whether or not you can claim CPD for attending this. I don't know. You know, in my mind, continuous professional development is continuous professional development. If I'm teaching you something, then you continue to develop professionally, and so that's CPD. However, I'm sure that your controlling body has some, I wanted to say ridiculous policy, but has some policy on CPD that it wants you to follow, and I don't know whether or not this will qualify or not. But be that as it may, that's not the purpose of this training. The purpose is to, like I said, keep my staff updated. And then I thought, well, we'll have external people join as well, because why not? Right, so the income tax exemption in section 10(1)(e). Why do we have the exemption for income tax for HOAs and body corporates? Again, I repeat that I'm focusing on body corporates, but that's not and HOAs, but that's not the ambit, the entire ambit. So let me ask you this. Why do we have an exemption? Right? Think about this. Right? Ultimately, what does an HOA or a body corporate do? It's just a jar that pulls funds to fix stuff if it gets broken or to maintain stuff. So if you remove this body corporate and this scheme or this HOA scheme, and you say, well, let's assume I own a full title stand or a house, right? Or freehold property. If I say, okay, listen, I'm going to take some money and put it away every month for in case the roof starts leaking so that I can repair the roof, or for in case I have to lift the paving because there was 80,000 rand water leak underneath my paving, which actually happened to me. So if I put money away to cover those costs, should it be taxable? It's after-tax money that I'm just putting away to save. And an HOA, its main purpose, and a body corporate's main purpose is to do exactly that. So it is to pull together the funds that is necessary to maintain the common property. That's why we have an exemption for body corporates and HOAs, right? Now, the trouble is with levies is body corporates and HOAs often term things as levies because that's just what they know. They're supposed to call the money that they collect, but then often they are not necessarily levies per se, right? So let's just quickly talk about this exemption. We'll talk about the types of levies that qualify and those that don't, because not all levies qualify for the exemption, whether for VAT or for income tax. So technically speaking, when you look at section 10(1)(e), unlike a PBO where you must, because in the case of a PBO, section 30 says you must apply to SARS for registration. We know you apply the tax exemption unit. Now there's that form IT12EI, or whatever the form is, that you're supposed to file. The exemption in 10(1)(e) doesn't have like a corresponding, as far as I can recall, section 30 that says you must apply for registration. What it does say is you must obviously satisfy the commissioner that you are the type of entity envisaged in section 10(1)(c). And so that typically in practice takes the form of an application to SARS. So you'll have to typically go and apply. I think technically speaking, you can satisfy the commissioner after the fact. And I have had many cases where we had to dispute assessments where the commissioner's satisfaction had to be established. And SARS would say it had to be established beforehand. And we said, well, where in the section does it say that? I know that's your practice, and I appreciate the practice, but that doesn't make it law, right? So the path of least resistance, quite naturally, obviously, is to just apply for the registration, and there is a possibility to backdate it. I have had PBOs that I backdated for 30 years, right? But you have to show that obviously in each of in my example, 30 years, and I'm talking about PBOs in particular, and it would be the same concept in the case of an HA or body corporates. You'd have to prove that for each of the last, in my example, 30 years, the activities that was conducted qualify. In that case, as a public benefit organization, but in this case, then as a body corporate or an HA. So again, let's then look at what are levies, because the section and the Income Tax Act doesn't define it, right? In fact, Section 10 says, there is 10(1)(e), it says any levy received or accrued to, and then it goes on to mention the types of organizations like HOAs. So it doesn't define what a levy is. Right, and so we have to go and look at, in terms of the normal interpretation of statute, we have to go look at where. Where do we go and look if the definition isn't in the Income Tax Act? We go to the dictionary, right? And ultimately, it is an amount paid to cover expenses relating to the collective interest of all members, right? So it is the money that the HOA or the body corporate collects to manage the collective interest of everybody in there, right? Does that then mean that everything that the HOA or body corporate calls a levy is then exempt from income tax? No, because I alluded to it earlier that some of these HOAs and body corporates, not all of them, but some of them will refer to things as levies when that's not really what its purpose is. Its purpose is something else. It's not to manage the collective interest. It is to do something else, in which case it's taxable. It's not exempt. Right. Special levies, for example, and these are examples from SARS's notes. So SARS says a special levy is typically charged to cover large once-off expenses, right, related to the collective interest of everybody. So that's a levy, properly so called, and qualifies as exemption. A building penalty levy, they say, if you look at the purpose of a building penalty levy, often the purpose of that levy is to cover the extra maintenance cost of the large vehicles going to drive on the pavement to get to your site to build your thing, right? The extra security that needs to be appointed while there's, so it relates to the collective interest of all members. And so that indeed, SARS says we agree that those things are, in fact, levies that properly so-called qualifies for the exemption. They deal in quite some detail with what they call stabilization fund levies. So this is a fancy word for entry and exit levies. You know, there are some estates, if you go buy into the estate, there's an entry levy you have to pay, normally as a percentage of the purchase price, or an exit levy when you sell. They call it stabilization fund levies, and they say that these typically do qualify, and I've got the criteria that SARS had put in their note, I just copied it into the slides. They say it typically does qualify, provided that the Constitution, the founding document, if you will, of this HOA or body corporate establishes this stabilization fund, and there are rules that govern it, and it may only be used to fund expenses related to the common property. We could see where they're going with this. Yes, it's fine if you're going to use it for the collective interest of all members. But of course, you can see how people might say we're going to charge an entry levy so that we can build a restaurant, so that we can start renting it out, or whatever the case might be. All right. So there are certain requirements, but interesting. There are examples, and we'll go through the examples now, of levies that don't qualify. And so what is important to take from this is that this is not a blanket exemption for HOAs and body corporates. There's no such thing. It says its levies are exempt. Everything else is taxable, subject to a 50,000 Rand annual exemption. Right? I think it's 50,000 Rand. At least that's what I put in there. Right? If you charge a fine, that's not a levy. Right? SARS says that's in their note, they say that's not a levy. That's VATable. Subject to income tax. We'll talk about VAT in a minute, because VAT is slightly more complicated when it comes to fines. But for income tax, a fine or late payment penalty, if you pay your levies late and they charge a penalty for that, they said that's not a levy. Oops. Okay, that's not a levy, right? So now there are other examples of levies that we've come across in practice dealing with large estates, where the answer wasn't as clear. There were many things that they charged, and I've got a list here, and I won't obviously mention the estate that we worked on here, but I'll give you examples of certain types of fees that have been charged before, or that I've seen before charged by, I think this was an HOA, that we had to determine, is this subject to, it was more of a VAT issue than it was income tax, but it's very close. In fact, when you look at the VAT section, like I said, the note doesn't actually deal with VAT, but when you look at the section that governs VAT, it's section 12F. And insofar as it relates to a body corporate, it says the supply of services to any of its members in the course of management of an association of persons where the commission is satisfied subject to such conditions as he or she may deem necessary, such association of persons has been formed solely for the purpose of managing the collective interest of the residential property use or ownership. So it doesn't say levies, it says where the cost of managing that is met out of contributions levied, if you will, whereas section 10(1)(c) says levy received by a recruiter. So it's very much the same thing. And so one has to always establish what is the nature of this income stream. Forget the name. The name is very misleading often. They call things levies when they're not. Tennis court levies. What is that? No, it's the amount you pay to rent the tennis court. That's not a levy. That is rental income from making available the tennis court. That's a taxable supply for VAT, and indeed also it's taxable income, right? Squash court levy. You know, what is it for? No, it's to play squash. Okay, well, that's not a levy. It's not to manage the collective interest. That's to run effectively an enterprise or to conduct a business. So we have examples here of something that we looked at for VAT, and to see whether for VAT purposes, which is very much the same but not identical. Now, if you want to know the difference between same and identical, I'll refer you to 3 weeks ago an interpretation note about raising fees, right? So it's very similar but not identical, section 12F. So we had dealt with an HOA where they charged a clearance admin fee. You know, when you sell your property, you need to get a clearance certificate. And so there's some paperwork that the HOA needs to do to get that certificate to you. They charge you a fee for that. That's not a levy, that's a fee, all right? And so that's an example of a vatable supply, and indeed I think also probably has been taxable for income tax. Reminder fees. If you pay your levy, if you don't pay your levy on time, and they send you a reminder, right? I find it fascinating sometimes the types of fees that these people come up with, but the cost has to be recovered, I imagine, right? So you send a reminder fee. Well, that's not a levy, and the true sense of the word, so that is vatable and indeed also taxable. Tennis court rental income, that's an example of something that clearly isn't a levy and is taxable both for income tax and indeed for VAT purposes. Building penalties, technically for VAT is a non-supplier, so I don't want to get into that. Attorney's fees, if you pay an attorney to collect money and you recover the attorney's fees, example of a vatable supply. This particular estate or HOA had a shuttle that kind of ran in this, or shuttles, I suppose, like buses, little small buses that would run and I don't know, do what, pick up kids or transport people, whatever. And the HOA would own the shuttle, and they would obviously on the van itself or the shuttle itself, it'll allow the people to advertise, you know, to put branding on it and advertise, and they charge a fee for that, which I understand, but that is not exempt income. That is normal taxable income, and indeed also subject to VAT. All right, once off biometric registration fees. Some of the estates with these biometric systems that you clock in, like you have at the office here. So if you've got to once-off pay that when you move in, let's say you buy a place in an HOA and there's a once-off biometric registration fee, that is taxable supply for VAT. It's also taxable for income tax purposes, right? And so it's not exempt. Access card income, some of these estates will, for example, let's say you've got a contractor that's going to come in, they will do a temporary access card so the guy doesn't, you know, make the queue for residents be that long. And so they'll charge a fee for that. That is an example of something that is both, in my view, at least from a VAT and income tax perspective, taxable. And then also this particular estate I looked at, just to give a little bit more background, they charge background fees. So if there's a tenant that wants to rent a property in an estate, they'll do background checks, because some tenants only rent places to steal from the other properties in there, right? So these guys did a background check, which is great, but then they charged a fee for that, so obviously to the owner, and that is not a levy, I think. Look, one can debate these things, right, because it is very nuanced. It becomes really nuanced, but the question is not whether you call it a levy. That is the point of what I wanted to say, is not a question of whether you call it a levy, it's a question of what purpose does it serve. Is it a quid pro quo? Is it for some form of quid pro quo? In other words, are you doing it in exchange for something? in particular, that's only to the benefit of that particular guy who's paying for it, then probably it's taxable, it's not a levy. I mean, because you'll recall we looked at this in detail for that other estate, and we said, okay, well, look, what is this exactly for? And you often find when you ask the trustees of the HOA, say, what is this for? You have to appreciate also that they've just taken over this role from the previous guy who took it over from the previous guy who took it over from the previous guy, so they're just carrying on with what they did before, right? And when you sit down and you ask them, what is this levy for? They often go, oh, what do you mean? Nobody's given thought to that question. They just see this levy income, and so they treat it as such. And so if you start asking the question, what is this for? Can I make a direct link between this income and that person's benefit, or in that income and the benefit of the collective interest of all the members? If I can make a link, so it's for the collective interest of all the members, probably exempt for both VAT and income tax. If not, probably taxable for both income tax and VAT. Right, so that is the point of this exercise, of this session today. Also, just for interest sake, I think body corporates and HOAs, or those that fall into 10.1 is it E, don't have to pay provisional tax. Donations, I think, made to them is not subject to donations tax. They are subject to CGT, though you don't expect an HOA body corporate to sell common property. Right, it would be odd. It's not impossible. I mean, I remember years ago, when we bought a place, there was that piece of land in front of that was transferred to us. So technically, that would be a CGT event for the. Look, I didn't serve on the. Thank goodness, I didn't serve as a trustee at the time. So they are technically subject to CGT. All right, I'm going to pause there. That's a lot of information, but that is what the note is in essence about. It is very practical. Lots of people obviously live in estates or body corporates, and so they need to understand what the VAT treatment is.